Trade Genius.
Hi, this is Philip at Trade Genius, and I'm here with Bob Kudla as always, and this is the Trade Genius podcast. Thanks for joining us. We're kicking off a new format. We've been on and off YouTube, but now we're going to be back on a more regular basis, and we're going to be interviewing Bob, and we'll go back and forth on some of the macro issues that are going on in the markets, as well as crypto and metals, and try to cover the whole gamut of things and give you guys a well-informed take on what's going on in the markets so that you guys can make better investment decisions. So, Bob, thanks for joining us. How are you doing today?
I'm doing great, Phil. How are you doing? I'm glad we're re-kicking this thing back off.
Absolutely. Yeah, I think it's overdue. But yeah, glad to do it. So what we're going to do is we're going to dive into some of the topics that are kind of driving things in the market. So I'm going to kick Bob a few questions and we're going to get right into it. So first things first, Bob, in your view right now, what's the number one macro thing that's affecting these markets?
Yeah, Phil, we get this question all the time, and people are trying to figure out really what really moves the market. And it's become extremely clear here, if it's not been obvious to everybody in the last 6 months, is the Federal Reserve is the end-all, be-all in terms of the value the stock market represents to the world. So if you take a look at world central banks and you look at the stock markets of those countries, it's almost a one-for-one correlation that if the Fed is providing liquidity to the markets, the stock market goes up. When the Fed is eliminating or reducing liquidity to the markets, the stock markets go down. And so to us, you don't have to be very cute about it. If the Fed is telling you and doing things to reduce liquidity, you can expect the stock market to suffer, and that's what's been happening.
Gotcha. All right. Now, how's the Fed able to do this?
Yeah, there's a number of things. The obvious thing that people think of first off is the Fed can control the stock market or the economy through rates, but that's a simplistic view. The Fed actually has a number of other levers in their toolkit that are actually more powerful in terms of pushing money in and taking money out. All the rates do is really drive the cost of capital on the short end of the rate curve, meaning, you're talking, down near the T-bills and the 1-year rates and overnight rates and stuff like that. But the Fed has to, when they really want to take action in the markets, they actually have to take money out of the stock market. Or if they want things to happen, they push money into the stock market. And people heard the phrases QE and QT, and really what those are essentially, they're money moving in and money moving out. So the Fed has this tool, called the balance sheet, right, where they're buying bonds. And maybe I should take a step back too. So when the government overspends, they create bonds. Well, the prime brokers, the banks, are required by law to buy these bonds. And so normally what the Fed has been doing during a QE environment, the Fed has been actually buying those bonds off of the banks and keeping the banks liquid. The banks then can use that money to either lend money into the stock market or lend money into the economy. And when it's QT, they don't buy those bonds. Banks are forced to hold them. Banks lend less. Banks have less money in which to speculate, and it drives the opposite reaction. So that's what happens when they with QE and QT. But there's a second part of that too. It's the around the mortgage markets as well. So the Fed's out there buying mortgage-backed securities, and that drives the rate of mortgages, in terms of for home purchases and refinancing. So the Fed stops buying mortgage-backed securities or starts letting them, what they call, roll them off, which they're doing now, or actively selling them. That raises the price of mortgages, and you essentially kill the real estate market. And the real estate market is part of the FIRE, right? Finance, insurance, real estate, which is a huge, more than 30% of our GDP. And so that quickly can suppress economic activity. But then there's one other component that people don't realize, but they're starting to now. It's called the reverse repo rate,
Mm.
or RP. And what they do is they're able to um, entice banks, incentivize banks to not use the money they have in reserve, but actually to keep them onto the Federal Reserve balance sheet, and the Federal Reserve then pays them, excuse me, pays them interest, which they're paying right now 3.05%, which equates to over $80 billion of annualized payments to the banks, either out of the Fed's profit or out of the Treasury's profit, which is essentially goes to the Treasury, because all profits at the Fed, other than their expenses, goes back to the Treasury. And that has a profound effect on the stock market as well. There's some lesser known things that we're seeing, we'll talk about in a minute, by swap lines to other countries and things of that nature. But those are the biggest three that drives the what people look at as Fed liquidity.
Okay. So essentially, for the folks out there, it's not just a matter of raising rates or QT, but really they can basically throttle the amount of money going into the market, is what you're saying. And so it could appear that they're tightening, but in reality, they're letting money in. And on the surface, to most people, as far as like retail people go, totally oblivious to this.
Yeah, I mean, look, they can actually make the cost of living for the average person more expensive in terms of credit card and bank loans and auto loans. But at the same time, they could be pumping liquidity into the stock market and have the stock market go up, or the reverse can be true. So these things are kind of independent of rates, and a lot of people don't get that, or maybe soon will be understanding that the Fed has this basically 3D chessboard that they're using.
I think that's a great point and a great analogy, right? Because it's not just what's at the surface, but there's another element going on. So, we've been at Trade Genius, we've been looking at that metric, and so we have. Well, maybe you can talk about it, or we can talk about it. But we have a way where we can basically, essentially say, okay, look, it looks like that's happening, so it's like it's risk on, or they're turning off the faucet and it's risk off. So maybe we could dive into that and maybe start with like what your thoughts are on taking that approach from a practical standpoint, as far as people, as whether they're putting money to work in the market or they're not. Like what, based on that and that algo, like how do you interpret that as far as using that in a practical way for people to invest with?
Yeah, I mean, look, it was kind of one of these things where, we kind of knew it intuitively, but when you took a look at it from a measurement standpoint, it became an epiphany for us. And when I mean us, Phil and I, we're the ones that basically are primarily using tools such as these. So what we've noticed, I mean, obviously, when the market's going up, it's easy to make money. When the market's going down, it's much harder to make money, because you have to do counter trend trading, number one, or number two, you have to actually buy into the inverse ETFs, if you will, like SARK or SDS, things like that, to make money. And when the market's in a bear environment, people think, oh, you just short it. Well, it's not that simple. So there's a whole different set of rules involved there. So if you kind of knew, what season of the year you're in, if it's summertime, you're not going to come in with a heavy coat, right? You're going to have shorts on and t-shirt, right? And you're also not going to go ahead and run to the beach in January, if you're up in Maine. So we consider this Fed liquidity environment very important to us. And, and I just want to throw kudos back to you, Phil, because you took these data points and you were able then to create for us a Fed liquidity tool that basically tells us, essentially, we call it risk on and risk off. And I'm just going to kick it back to you. Maybe you can explain what this tool has done, or how you developed it, and then basically, how we display that, and how we could share that with other people.
Yeah, so essentially, for the folks at home, it's not an original idea by me by any means, but it is a measure. I think that where the epiphany comes from is realizing that, basically when you take the Fed's balance sheet and you look at that and you look at what they're doing with the reverse repo and you look at what the Treasury Department is doing, right? It's those elements, and if those things are either adding to the market or they're taking away from the market, right? And that's the gist of it. But formulating that into a signal as far as risk on and risk off is a little trickier, and so that's what we've done essentially. So basically, the most I would say the cleanest time frame is weekly. In fact, that thing said risk off at the top of the market, like just right at the top said risk off, and it hasn't really said risk on since then on a weekly basis. Now you can get more signals on a daily basis if you look at the daily chart versus weekly candles. And that's shown us a few times already where we can expect these bear market rallies. The June low, if you looked at the data we look at, you would have seen that it was risk on most definitely. And then that ran all the way into August. And so, and we're seeing things that may potentially point to something similar here real soon. So, but the trick was trying to take the data and basically say, okay, because it's not like the data comes in a very linear fashion. It's if you look at the data day to day, it's up and down and up and down. So you have to kind of stand back and see, okay, what's the general flow going to be, and then when you have and take that aspect of it and crunch the data, you can get basically a risk on or a risk off approach to that. And then it helps too, because if you know liquidity is flowing into the system ultimately, regardless of the news, right? Because a lot of news is just noise, or it's a trigger for something that's already pre-programmed, and that's going to happen in the market regardless. And I think that's why sometimes, and maybe you can chime in on this too, but where retail might be confused because the headline says this and then something else happens, right, in the market. And a lot of times liquidity is agreeing with what actually happens in the market versus what you're being told in the headlines. It's like by the time you read it in the headlines, they've already made the moves. And so you see like the opposite play out because they've priced in that headline. By the time you read it, it's already been priced in, and now they're going the other way, looking forward 2 weeks in advance. And that's how the professionals operate, and retail sitting there going like, oh, what happened? I thought it was bad news, and the market's going up, or vice versa. I mean, you have any input on that?
Yeah, I totally agree. We even actually joked about it today in our trading room, is that big money is never surprised. Big money is
right.
The one who does surprise, and so a lot of times they do things to set up retail to get them, because remember, if they're buying something, they need to get somebody to sell. If they're selling something, they need to get somebody to buy. So they create these environments where they catch you goofy-footed, to use a surfing term, so that they could go ahead and collect these things at cheaper or sell to you at a higher price. And so that's exactly correct. And so the thing too, Phil, what we've done here with the liquidity tool, it's not important for us to be right today or tomorrow with it. The important thing is to know, and this is an engine too. The Fed is not laconic on this thing. They don't say, oh shoot, I was wrong, I'm going to lift liquidity, now I'm going to dump liquidity. They're when they start doing this thing, they're like a super tanker. Right. Liquidity is going to pour back in, or liquidity is going to pour back out. The important thing for me as a swing trader is to know that ship is turning, and positioning myself out a couple weeks for the trades and let those trades mature. And so that's how the best way that we use the tool to know that we can see the turn occurring. And of course, seasonals help as well. So if you get a liquidity risk off signal in August, and September is typically a weak month for the stock market, well, you should be positioned short, as we were at Trade Genius, trying to get people to take advantage of these down moves that we expected through the month of September. So that I could consider that tool a macro tool for us. Obviously we have tools that are a little bit more finely adjusted to day, but it's an incredible macro tool, Phil.
Yeah, I guess you don't want to fight it. In other words, you'd rather trade in the direction it's telling you, and just take that side of the trade.
Yeah, and the other thing too, you brought up a point, the weekly, daily. You have two signals in there. One is the daily signal, and one is the weekly signal. And if you get a daily and a weekly combined, like what we had going into this sell-off. It should be screaming at you. And we were telling people all summer long this bear market rally is going to end, and we're likely to make at least a double bottom, if not a lower low. And for people to, to trim their long-term positions, so you're going to be able to buy them at a cheaper price here going into the fourth quarter. And the same thing in June, people were shorting what they call shorting into the hole, which means that as it was plunging, people get more and more bearish. And our liquidity signal was waving a flag saying, hey, this thing's going to turn. Do not short into that hole. Right. Meaning don't give the big money your money for free. And we get the big turn. So right. That's how we use the tool at Trade Genius.
Okay, so little birdie told me that people might be able to have access to this risk on, risk off signal, and I think if you're listening to this at home and realizing that there's this underlying element that drives the markets up and down, regardless of what you're hearing and seeing, you might be interested in how to get this. So, Bob, how would our listeners be able to get access to this indicator?
Yeah, so one of the things that we've done with this is that is we've created a newsletter. We've had a lot of people that want to, number one, day trade the market, but number two, they want to kind of know what season we're in on the market. So we created a I wouldn't call it daily newsletter. It goes out like 5 days a week. So it's market daily newsletter that really looks at a number of components. And I'll let you share more detail because you actually assemble it. But we took a tops down approach to this. We look at probabilities a lot. So, we have a sense of what happens during, January through December. We also look at what happens within the month structure itself. And within that, we look at what happens within the week structure itself. So we have kind of those data points already assembled in there. And then in addition to that, there are tools that look at not only the Fed liquidity, and I won't talk too much about the other thing because we're going to talk about it in a minute, but we also look at the stock market is driven a lot by the derivatives, which you would know as options in the markets, kind of the tail that wags the dog. Mm-hmm. And so we have a sense it's kind of like a bumper car. It's telling you whether or not the big money is going to be absorbing that selling and buying, or if they're going to be trading with that buying and selling. And that's called, positive and negative gamma. Forget the terminology; it's there to confuse you, but it's basically saying is the market get more or less volatile during the day, and if it hits those bumpers at the end, that usually means that when people are trying to short into those bumpers, usually you get a reversal. Vice versa, if it's pushing higher and they're trying to go long into the breakout, the market's going to push it back down. So we assembled all that data daily, and we provide that information to our clients that purchase this newsletter. And me personally, it will change your life. A lot of people make mistakes because they make the macro mistake. I don't know how much time, Phil, this. We've been doing this a long time. How many times people say, well, I'm going to short it tomorrow. We're looking at our data point and say, well, why would you short tomorrow? Right. All the data is pointing to it going higher. I'm going to cough, excuse me. It's going to go higher. And how do you know this, Bob? How do you know this, Phil? And we're like, well, the probabilities are telling us, the volatility derivatives are telling us, the Fed liquidity is telling us. And lo and behold, we get the reversal. And people think, wow, you guys are really geniuses. Well, we're geniuses in the fact that we assembled the data and we let the data do the trading for us instead of our own intuition. And that's what this does for you. And, we got plenty of kudos from people. Just today, when you even mentioned that we're going to talk about this to our clients, one guy said it changed his trading life. He said it's totally basically a dispassionate view of the market topology, what's happening here. And look, and what you pay for this is nothing to what you get out of it. I mean, one good trade a month pays for the whole month. So I'll kick it back to you, Phil, if I missed anything. I know we talk on the weekends. It's a little bit more meatier because I throw in some of the weekly stuff and the changes, what's going on. But beyond that, I think I covered it pretty well.
Yeah, there's going to be things covered in there that are, I think, in as far as the internals of the market go, you're going to see things that you're not aware of or privy to. But it's just that we look at the things that matter most, and the internals that happen. When I say internals, I mean the internal metrics of the market. Shares that are going up, shares that are going down. Where the strength is, where's the breadth, things of that nature. And so we have this laid out in a pretty easy to understand format, and it's going to help you catch these larger swings, like for today, for example, right, Bob, in the VIP room, people are like, we're going down to the 3,600, those 200 weekly moving averages down there. But we knew from, the derivatives and other things that there wasn't much incentive for this market to get below 3,600 on SPX, right? So, and that's directly related to like what we look at, the liquidity, the internals. So you're getting all of this information in that newsletter. So, especially if you find this market confusing, or, why the heck is this thing rallying so hard? This newsletter is going to help kind of frame what's going on, and you'll actually be expecting these turns versus, being surprised by them, for example. Or, the market looks like it's going to fall off a cliff, but, well, in reality, it's probably not going to fall off that cliff because the internals are saying that there's huge support under there and things like that. So that's, I think, the biggest advantage to having that newsletter is knowing, like, okay, we got big structural things here or big structural things there that are going to keep this market in a range, for example, or it's at risk of rolling over, or it's not at risk of dumping. So that's what the newsletter is going to help you to do, especially if you're day trading. But even if you're more of a swing trader, or just looking at where are you going to get long in this market if you're standing on the sidelines right now, because it is a bear market. And so this newsletter is going to help you also let you know where you should either redeploy capital, or if you're taking the hedging approach, let's just say you're hedging your portfolio, where you would take those hedges off or put them back on. We have very specific things that we look for in that. So it's not only great in a bull market. I mean, bull markets, granted, are easier to navigate, but the hardest thing to navigate is a bear market. And I'd have to say we're pretty on top of that, and what to look for exactly when these bounces or these turns come in the bear market. So anyway, that's my viewpoint on the newsletter. But like Bob says, I put stuff together in that as well. And I think you guys will find it extremely interesting, especially when you see the graphs and the different metrics that we look at, because most people aren't looking at what we look at. So I think it'll be very beneficial for that.
Yeah, and we actually use English. So we try to do, I hate all these terms. So we actually use English too. We'll tell you, do not short this market tomorrow. And look, and one of the things for the podcast too, guys, we're not always going to be just pitching Trade Genius here. We're actually trying to inform you, is that we're going to give you some skinny here going into each day. No matter what topic we're going to talk about, we're going to circle back. But one of the things that we know is, you had a Friday down, Monday down, and probabilities tell us Tuesday's up. And so, those are the kind of things that we share with you, and some of the stuff's in the newsletter. So, like I said, if you were part of Trade Genius, or you had the newsletter, you'd have been positioning long going into tomorrow. And even if tomorrow is flat, we got long before the close because we knew where that support area was, and we started building positions right away, right in early afternoon. So just go to tradelikeagenius.com and just ping Matt and check in on that newsletter. I think you really like it. And if you don't trade with us, definitely check out our specials. We normally do them when I do interviews, but ask Matt if he has any specials running, and he'll take a peek inside the store and see if he can get you any kind of deals.
Yeah, and we'll put a link to the newsletter if you guys are interested in checking that out, tradegenius.co/newsletter. I'll put a link below on that so you guys can check it out. But if you're interested in the liquidity that we talked about and how to track that, because we talk about that a lot in that newsletter day to day, that'll be a way to do it. Okay, I know we got some charts to get to before we wrap this thing up. So we know we look at that. I guess these charts kind of segue into the other things that you look at, right, Bob?
Yeah, absolutely. I thought it was really important for you guys to see, because it kind of ties into, like, okay, is the Fed pushing too hard right now? Is the Fed going to stop soon? Is the Fed doing damage now to the market? So there's some really interesting data points I thought we could share. And And right now, Phil, are you going to bring them up?
Yeah, so I think the
Yeah.
next chart we're going to look at is the broad U.S. money base. So let's pop that up here.
Yeah.
All right, so tell us about this chart.
Yeah, and I don't see it, Phil. So,
Yeah,
what am I doing wrong here?
I don't think you're doing anything wrong, but I'm going to help you out here
So,
by sharing my screen.
yeah. So this is how it works with Phil and I. So Phil's the technical genius, and I'm the guy lost.
I don't know about genius, but we'll figure it out. Do you see it now?
Yeah, so this is really fascinating for people. This is what we're talking about. And this is one of the things that kind of goes into what Phil does with the liquidity is that if you notice going into 2020, they just were ripping this thing. Okay. And this is why everybody thought they're going to become gazillionaires on their real estate and gazillionaires on their stock market. And then the Fed took the punch bowl away and they overshot it to the short side. And this broad monetary base not just affects the U.S., it affects everybody around the world. A lot of people have dollar-based loans out there. A lot of countries link their currencies to the dollar, and so it's causing a lot of harm around the world, and it becomes a feedback loop. I don't think I have a chart talking about the treasuries, but people are saying, "Oh, people are selling our treasuries." They're selling it not because they want to; they're selling it because they have to, to maintain their currencies from going actually sky high. So they sell our treasuries and buy their currency to counteract what the Fed's doing to them. And by doing that, they're trying to keep the dollar from getting too strong and really blowing up. See, a lot of these countries are mercantilist. They like a little bit weaker currency to the dollar. When it gets too weak, a lot of these countries import inputs, for energy and for food in addition to their raw materials. And it gets to a point where you can actually destroy an economy. Look no farther than what's happening in Europe right now with their dependence on foreign energy. You set Russia aside for a second, it could be the Middle East, it could be U.S. for that matter. And it's literally Europe's not going to make it. So that's one of the things here. The U.S. monetary base is telling us that there's not enough dollars out there. There's a dollar shortfall. It's very, very deflationary for us on the long term. On the short term, it's very inflationary.
So basically, the Fed has basically sucked back in a lot of the dollars that were abroad. Is that how we should interpret that?
And domestically and abroad, and people get confused what a dollar is. There's a dollar that you have in your wallet, right? Mm-hmm. And then there's what's called credit dollars that get created out of thin air when you do a loan. And when those loans either close or they default, that means dollars are going away. And so when those credit dollars go away, there's a demand for what I call the printed dollar. And so you start seeing hoarding, and you can turn a bad situation into an awful one. That's how you got the Asian contagion back in the 90s and so on and so forth, is that when there's not enough dollars out there near the reserve currency, we're basically starving the entire world.
Gotcha. All right. So that seems pretty stark. I mean, that's crushing levels that we've seen even in the great financial crisis, Great Recession of 08 and 09 by quite a bit. So that's pretty amazing. All right. So the next one is the monetary base year over year. Let's switch over to that chart. There we go. So tell us about this.
Yeah, it's a similar chart, just showing it in a different way. And it's basically just showing it that money's going away. Okay. And money and velocity are going away. So it's a big problem. Not only is there less money, but the money's not shoveling around like it was either. So usually that's going to portend into slower economic activity going forward. And you can see, look at going into 2019 to 20, which is ironic. I'm not going to get off on a conspiracy theory, but you notice that monetary base was going up well ahead of people getting sick. Wink, wink. Okay, and now it was sitting up there for quite a bit of time, and then they had to drag this thing back.
Gotcha. All right, so I guess it would be prudent to know when these reverse course, right, and when that broad base starts to go back up.
Yeah, you'll start seeing it, and it's going to come with QE and up, and that's where your next chart comes into being. This is this chart is the graphical representation of what data Phil pulls out for his liquidity chart. So the one on the right is basically showing the Treasury. It's showing the reverse repo and the total Fed assets. And you can see when it starts to roll over, you know, we should have when did the Fed officials close their stock accounts indicator, which was in the fall, which tied directly into the top of that curve. So, you know, right now the biggest thing that will move first is watching the reverse repos, right? And then from the reverse repos, if they start to fall, more money's going to come into the account. Then, you know, if the Treasury, you know, has more cash, they're going to spend it and not need to go to the Treasury markets. And then obviously the QT has to stop. And so that thing has to start turning. If you notice, it looks like a sawtooth. So, you know, you have the big macro, and then you're going to have these micros. We measure the micros too. So we'll know from week to week whether or not are we leaning risk off or are we leaning risk on.
Got it. So that basically that green is the fuel for the market.
Absolutely. That needs to turn.
Yep. And then that's what one of the things that we monitor and one of the things that we cover in that newsletter. All right. The other thing, the last chart we wanted to look at before we sign off is this earning remittance. So let me bring that up here. There we go. So
yeah.
Tell us about this.
Yeah. So this is one of the areas, I think one of the things we want to talk about is maybe when will the Fed stop doing this? And this is where the Fed now is losing money. Okay. So the Fed is a nonprofit organization. Okay. The Fed can't win money. The Fed can't lose money. Okay. But what the Fed does is when the Fed makes money, they remit back to the Treasury its profits less their skim, right? When they lose money, they still keep their skim, but the Treasury now has to make them whole. And so we just dove into a massive negative position that's primarily around the reverse repos and the QT. The Fed's not earning interest income anymore from their holdings. They're actually paying out. And this is going to raise political alarm bells around Congress, because can you explain to the American people why American banks are getting $80 billion of free money to not do their job?
Right.
Okay. At the same time, we're sending $80 billion over to Ukraine. Why people can't get their houses fixed in Florida, or their homeless people can't get homes built in California, et cetera, et cetera, et cetera. So I think this is one of the things that the Fed knows is this is going to become problematic for them. And so I want to show people this is very rare that this happens.
Yeah, I was going to say the Fed's not in the business of losing money usually. That's usually a very tight club, and then they always make money.
Yeah, and if this was a non-reserve country,
mm-hmm.
this is what you call an ending event for the country's currency.
This is pretty eye-opening. I actually had not seen this until you had shown it to me prior, but I thought it was just very eye-opening. It's wild. Because so essentially the Fed's paying the banks, right? Instead of the banks paying the Fed?
Yeah, no, actually, yeah, right. So this is what the Federal Reserve pays the Treasury. And so usually when they run a surplus, they give money to the Treasury. And that's why people always say, you know, the government can never, United States government cannot go bankrupt because the Federal Reserve can buy all the bonds out there. Are you with me?
Yep.
And then they collect all the interest, and what do? They just turn it back and give it back to the Treasury, and all you're really doing is monetizing the debt, right? Mm-hmm. This is like an opposite of monetizing the debt. We're literally causing the Treasury harm. The Treasury has to borrow this, Phil. Okay, they had to turn right around and borrow from the banks that they gave money to. So it's like a double whammy. You're sitting here saying, why am I a trade genius? I should own a damn bank.
Right.
I mean, it's tails.
Well, that's hard. That's hard to start a bank. That's a tight club.
Yeah, we're not in it. So, but that's what that means. This this is a no bueno move here. They're going to have to fix this.
Okay, so and if you're listening to the podcast and not watching the video, basically it shows that the earning remittances due to the Treasury is usually a positive number, meaning the Treasury's right, because the Fed has to pay profits to the Treasury, right?
That's right.
Well, now it's really negative. Like as much as it's usually positive, it's that much negative. So this is, and it's unusual because most of the time it's above zero. It's positive. So this is a highly unusual event going on here. Thanks for bringing this out, Bob. So what do you think? Is this going to force the Fed's hand to stop QT, or is something else going to cause that? What's your take?
Yeah, I think that's number one, and number two. And I have some more data points. We'll maybe talk later in the week about it. But there's starting to be some emerging data here. That everybody noticed the United Kingdom has intervened in their debt markets last week. They actually did QE. So the United States is the only last major central bank that's not doing QE right now. But what the Fed did, though, was they sent swap lines to the United Kingdom to kind of ease that. So start looking for more swap lines where the Fed's telling you they're holding firm, but they're letting liquidity go across the pond, if you will, or across to Japan, and have that money come rolling back into our country that way. Basically foreigners being able to buy stocks to lift the market up kind of through a bait and switch kind of a 3-card monte approach to QE. So and I think it looks like when we're getting to 4% here on the 10-year, it's starting to cause some fraying, if you will. So I'd be surprised if we got up that much more before the Fed has to kind of soften their language. And today, you were reading the Fed governor's comments today. That was the most dovish I heard a Fed governor in the last 6 months. So I think you're starting to see them prepare the patient for maybe a slowdown in this cycle, this attempted suicide they have for the world in terms of the dollar dominance to basically crush asset prices, because it's not really helping crushed core prices. It's crushing everything else. So I think we're at a point now where at least we're going to get a short-term relief in the markets, and then we're just going to have to see if recession becomes the fear instead of inflation.
Got it. All right. Well, I think that's going to wrap up today's podcast. I'm really excited about the next few coming forward because, like Bobby, you alluded to, I think we've got some other charts that are going to show you that there's some stealth liquidity going on, and we can cover that some more in the next upcoming podcast. So you definitely don't want to miss that because that's really going to help us determine what the direction is of the markets. And then we also have, midterms coming up and things like that, and that affects the markets a lot too. So before we wrap up, it's Tuesday. Monday going into Tuesday. So tomorrow, not a lot of economic data. I think there's some Fed speakers. So before we let these guys go, what do you see for tomorrow?
Yeah, I'm looking for a bit of a relief rally. Friday down, Monday down. Looks like we already started turning. Always look at the last half hour of the market to see what way the market's trending. And so I'm looking for a green day tomorrow and probably right into the CPI report. So we may get one of those moves. And, the CPI report is a lagging indicator, but the Fed uses it to beat us over the head with right now. So I'm looking for us to have a couple days of green here, and then we'll have to kind of reassess. And then, for us, for the rest of the week, we're going to try to do these every day that Phil and I are able to. We're going to talk everything. So put in your comments below what subjects you want us to talk about, because we're wide open with this. I'm looking at things, we want to do this podcast different than other things that I see, even interviews that I even participate on. I'm not a doomster guy. We're just in a doomster environment right now. I'm very optimistic person because you can always make money in the stock market if you kind of know where the river's flowing. And that's the kind of actionable information we want to give you. And Phil's the crypto guy. And hopefully I'll turn the tables and interview Phil here whenever he thinks there's something reasonable to talk about in the crypto space. But, even in this environment, what we care about mostly is volatility. more than direction, because we can make money from volatility, and we'll teach you guys how to do that. And this podcast, we're going to try to give you guys tools and hope. And then hopefully, if you like what we say and do, you want to join us. It's kind of the ultimate, snag here. Is like, wow, I like what I hear and see here. Maybe we can get even more out of these guys if I joined. But we'll talk real estate. Phil has a background in construction. And we'll talk gold and silver. I have some credible connections in that area. Phil obviously has crypto connections, and we'll talk market segments and sectors and what sectors might be bubbling to the top. Energy is huge. I think it's going to be a great place to make money. So we're just going to try to drive this Monday through Friday best we can. But tell us what things you'd like us to talk about. We'd love to hear your comments too. You're not going to hurt our feelings. We've been doing this a long time. You think, hey, Bob, you talk too much. You don't talk enough. Phil asks more questions. Whatever. We'd like to just make this podcast for yours. It's free. And then hopefully, you watching this show will help you make more money, and you'll tell more people, and we'll turn this podcast into something that is valuable to the entire world.
Yeah, and I second that. And also, if you guys can hit the like and subscribe, that helps a lot too. That'll help keep this going. We want to get this out. So the more people that are watching this, the better for us. It helps us out a lot. So we would appreciate it if you could hit like and subscribe on that. And like Bob said, if you have any input as far as what you'd like to hear us cover, or anything, you got any critiques on the production or anything like that, just holler down below in the comments, and we're watching them. We'll get back to you. And we appreciate that input. So, yeah, I'm glad to get to kick this back off with you, Bob. I think it's going to be. I think we got a lot of really good information at a very critical time in the markets, and I'm hoping that a lot of people can benefit greatly from the stuff that you're going to be sharing with them over the coming weeks. And like I said, like Bob said, crypto. We'll get into that. I know you guys have asked about updates on that, so. Probably on a weekly basis, maybe like once a week, we'll get on the topic of it and just discuss what's going on. But we'll get into that later on other podcasts. So anyway, we appreciate you guys being here. And Bob, thanks for your time. And
thank you, Phil.
Yeah, awesome. All right, guys, that's going to wrap it up for this first edition of the new format here with the Trade Genius podcast. Thank you so much for being with us, and we'll see you tomorrow. Take care. Bye-bye.
Trade Genius.